Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 23rd of May. I'm Daniel Lam, your host for the podcast. I'm currently on business trip in my first visit to Singapore in over 4 years. Yesterday, there was a really scary moment when my diamond chess queen pin fell out from my suit while I was leaving my hotel room. Now, that pin was a gift from my wife, and I always wore that when I went on financial TV interviews. So I found out about my missing pin when I was in the hotel lift and frantically went back to search the corridors and in my room twice before finally finding it in my room. So it was truly a case of shaken but not stirred. The soft Chinese data last Tuesday has shaken the Hang Seng Index last week, but the index certainly was not stirred by this correction. There was strong buying in the Hang Seng Index yesterday as it once again tested the 19,000 to 19,500 support zone. Besides the jawboning from PBOC last Friday, there were issues in US equities regarding the debt ceiling, which may lead to investors rotating funds back into Chinese and Asia ex-Japan equities. So our base case remains that the debt ceiling ultimately does get lifted or suspended, though how it get there could be at the 11th hour and drive significantly higher market instability than being appreciated by the market currently. So Treasury securities and CDS have been far more responsive to these risks, with CDS implying a 4% probability of technical default, while the VIX, which is the short-term implied volatility index of the S&P 500, remains quote-unquote comfortably in the mid-teens. But we need to remind ourselves that back in 2011, the S&P 500 was down 17% in 2 weeks when equity markets decided to violently reprice the risk of a US default. Also, we need to bear in mind the differences between now versus 2011. Besides the differences in political backdrop, the phase of the cycle was early at that time versus mature now. Monetary policy was easy at that time versus being tight now. Money supply was expanding versus collapsing. Inflation was low versus high, and equity valuation then was moderate, but now in US is still very rich. So investors should stay cautious in risky assets and use the strength in the US equities to rotate into high-quality fixed income. Moreover, it does make much sense to diversify your allocation from US equities and add to Asia ex-Japan equities, taking advantage of the recent soft patch in the latter. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.